When the government tells banks how to lend, taxpayers lose. Throughout history, financial systems have been used as tools of government policy. When government policies distort private sector investment decisions, economic growth suffers. Today's slow-growth economy follows a financial crisis caused by government policy. Leading up to the financial crisis, government policy was designed to stimulate investment in housing. It required mortgage institutions to increase lending to high-risk borrowers. When these borrowers defaulted, the financial institutions failed and taxpayers were left with the bill. Rather than learn from past mistakes, the government's recovery plan is to stimulate housing. It has propped up the mortgage GSEs with taxpayer support and subsidized mortgage interest rates through Federal Reserve purchases of more than $1.5 trillion in mortgage-backed securities. The prescription for a recovery is another dose of the policies that caused the crisis. New government policies continue to encourage bank loans to high-risk customers. One such policy seeks to ensure that protected classes receive their fair share of bank credit, regardless of whether they actually meet underwriting standards. If the characteristics of a bank's borrowers differ from the characteristics of the market population, the new policy is to charge banks with lending discrimination. No longer is it necessary to establish intent. These new rules are likely to restrict consumer credit and slow economic growth. Banks can meet these targets by restricting loan approvals for well-qualified applicants who are not part of a protected class. Perhaps the most serious flaw in Dodd-Frank is the power it gives regulators to control systemic risk. Systemic risk has not been clearly defined, so regulators face few constraints when exercising this power, and they can use it as a pretext for extending their powers. Regulators have used systemic risk to stop banks from making business loans by arguing that these loans are fuel for a credit bubble in high-yield mutual funds. And it doesn't stop with banks. If federal regulators identify a non-bank institution as a source of systemic risk, they can designate it systemically important and regulate it like a bank. They've already done so for an insurance company over the objections of non-bank regulators who see no evidence of systemic risk. And now bank regulators seem determined to designate asset management companies based on dubious arguments. History shows that when governments intervene to alter private lending and investment decisions, economic growth suffers. Congress must limit regulators' systemic risk powers and restrict their ability to control private lending and investment decisions.